Let's get rich. Okay, so now for the real meat and potatoes of this whole thing. It's in your hair, it's in your music, and if it's loud, it can be in your marijuana. Volume. Hugh, what exactly is volume?
Yeah, so volume is the amount of shares traded in a time period. Most of the time, we're talking about volume as the amount of shares traded in a day. But if you start to look at it, you can do volume bars based on the amount of shares traded in an hour. You can do the amount of volume. You can do volume based on the amount of shares traded every minute. But for the most part, when we're talking about volume, we're talking about the amount of shares traded in a day. So that's what we'll use as our benchmark. If you don't take anything away from this podcast ever again, take this away. Volume is everything.
Everything to me. Everything, huh?
Everything. I don't even know where to begin because volume is so important. I know traders that purely do not even use a chart to trade, and all they use is a volume scanner, is a relative volume scanner, and no charts, just level 2 and time of sales. That's how crucial volume is. Without volume, the stock's not going to move, or again, if too much volume, parabolic, and then again, if there's no volume to keep that price up, then we'll see it come back down. We call that a waterfall. Sorry, I swallowed my gum.
What the hell?
I know.
Vinny, keep this in, dude. Wait, can you we're talking about volume, but why do you do that a lot?
No, I don't. But I got so excited walking around that the gum went to the back of my throat, and I was just like,
dude, even I'm sitting down. So this is okay. What? Okay, I thought you wanted to start talking about accumulation already, but no, you were just excited and swallowed your gum. Okay, yeah. Let's proceed.
So, like I said, volume is everything. When we're looking at a stock, the only thing that we want to see is volume bars, consistent. So if you guys don't have volume bars on your charts, I personally use Thinkorswim, but you need to put volume charts on your platform ASAP. It needs to be there. You need to stop the podcast right now, pause it, and go put volume bars on. That is how short setups become. That's how, if you guys want to know how shorts usually find the best setups, is that they look at relative volume and they wait for the relative volume to go down to minimal. So when we're looking at volume bars, think of it like towers. You see a tall tower on the hourly, you see another tall tower, and then all of a sudden you see the volume drop. That's when shorts start to hammer the bid and start to short, because they see that the buying has the demand has dried up, and so what they do is they hammer that bid, and that's why you see these shorts that make huge amounts of money, because what they do is they hammer that bid when they start to see any kind of volume fluctuation. Now, I mentioned relative volume. That's where we'll go next.
Yeah, I think that's a really good place to go right now, because a lot of people, they don't know why 7 million's a lot on some stocks, but it's not a lot of volume on another stock. So I think that is really good transition into relative volume.
Yeah. So we get questioned a lot about literally what you just said. How do we know if 7 million shares traded in a day is a lot of volume compared to something that people say has 500,000 shares traded in a day, if that's a lot of volume? Relative volume. So relative volume is the amount of shares traded compared to the float. So something like BIOC that has over 100 million shares outstanding and has a float of over 100 million is going to take a lot more shares to move than something like Fran. Fran has 7 million shares, or BMRA has 7.8 million shares. So when we're looking at that, 1 million shares to BMRA bought is going to do a lot more to BMRA than it will to BIOC. This is called relative volume.
Yeah, dude, I think, and that's so important, because if you're not looking at the float and you're just looking at the the volume on it, I mean, you're missing a good percentage of it.
Yeah, exactly. And that is why you need, like I said, you need volume bars on your platform, but then you also need to benchmark that, because again, you won't know. Who cares if it trades a million shares in a day if you don't know what the benchmark is? So by having average volume, you can either do it by average volume per hour if you're more of like a scalper, or you do it by day. You can do it by, intraday. So you can do something like first half of the morning versus second half of the morning. And what this is going to do is tell you, okay, this is seeing more volume and more pressure than normal. So if you're a scalper, you can use that to your advantage. Or if you're a swinger and you're getting FOMO, and you can say, okay, this isn't, there's no news. This is just some accumulation. So relative volume, when you're talking about volume, is almost as important as volume itself.
I just realized Tim Sykes responded to my video of me waking up out of bed, and I have no clue what it says because he has me blocked on all my accounts. I may have to check that one out. Ooh, he might have me heated. Anyways, yeah, but what are your thoughts on tickers with volatile volume? Like sometimes they'll have 10 million in a day, and the next day they'll have 750K. How do you really handle that?
Yeah, so me being a swinger, it kind of what I'm looking for in my swings is, for instance, BMRA is a perfect example. We got in the next 2 days, we saw a huge jump in the price. And I think we're up around 30% right now. Now, the one day it had like 4 times the relative volume. The next day it had normal average volume. Now, the reason that, now some people are like, oh, like, Hugh, it's down 5% on the day. What's wrong? I'm like, guys, there's nothing wrong. This is a pullback. What you want to see, a clear, beautiful pullback, is when a stock makes a high on, this goes for any chart. When a stock makes a new high, dips a little bit, consolidates, and again, the key here is that what you want to see is that if you see low volume, but the price not going down, or the price staying and starting to consolidate, that is a textbook pullback. So if you guys have your charts pulled up right now, pull up BMRA for July 19th, 2020. Go back to, you can even go to the last 3 days, 1 minute chart, and look at it. You saw make new highs, you saw it come back down, and you saw the volume die off, but the price didn't go with it. That's the key here. You saw the volume die off back to average volume, and you saw the price still consolidate. That's what swingers love to see when you're looking at volume. You like to see relative volume increase, make a new high, come back down, volume die off, but the price not die off with it. Now, if you are, now this can still be, see, I'm hesitant to say this because I don't want people to set up volume scanners and just start, buying everything that has double relative volume. But if you're a scalper, when you see volume go from a drastic change, that is when you can use it to your advantage, because clearly something is going on here, whether it be a fund accumulating or whether it be, your favorite guru and Tim Sykes,
Dude, earlier today, man, you were talking before we started recording with the whole SPY thing going up along with accumulation, and you touched on accumulation earlier, and you just touched on it again. Whenever the S&P is adding another stock, I thought that was a really good example.
Yeah, so we can move into accumulation, and accumulation is really important to see. I know a lot of guys who they set up long-term scanners to find accumulation. So the perfect thing that you want to see on accumulation is, and this goes back to what we were talking about low volume and relative volume, how to identify the difference. When the SPY, there are hedge funds out there that one of the ways that they make their money is they wait for the SPY or the S&P to rebalance. And what they do is that when they add certain stocks, when they add certain stocks, the price is going to go with it, and that's because the S&P is taking a good amount of volume, and naturally the price is going to run with it. Now, so what hedge funds do is that they'll literally just scalp it with the S&P. So what they'll do is they'll use because the S&P isn't just going to market buy Apple for 400,000 shares. They're going to do what's called
why not?
Yeah, I know. Why not? What they do is that they'll set it over a 5 business days, what's called a TWAP. Okay, there's no one sitting behind the computer buying 50,000 shares in a click. It's called a TWAP. What they do is that over 5 days, every half an hour, they will buy 500 shares for 5 days. So hedge funds will calculate this, and what they'll do is that they'll take a huge position on Monday and just let it ride for 3-4%, because the S&P is trying to not keep the price down, but they don't want the price to skyrocket because they're buying so much of the volume. They try and keep the average volume the same. So what the hedge funds do is that they buy a bunch on Monday, and then they figure out how long or how many days it'll take the S&P to get the shares that are needed for the S&P. So say they accumulate 1% per day and they're buying 4%. That the hedge funds know that on Thursday, it's what's called the music stops, and they want to be out, because once the S&P stops buying, the price is most certainly not going to keep going up as aggressively as it was. Now, that kind of got off topic a little bit, but the point is how we can use this in penny stocks is that if we see something, and this is why Rumble originally came on my radar, if we see something on a long-term chart that it just looks like a ski slope, and the entire thing on the 180-day chart is down like 87% on the year. Now, again, you have to have volume bars up, but if you see huge volume bars, so say the stock price went from $10 to $1, and right around at the dollar mark, you start seeing huge volume bars, but the price isn't moving much. There can be a range. This is a clear sign of accumulation. So what does accumulation mean? That's when you're gathering stock, but you don't want the price to move, because you don't want the price to move, obviously, because you don't want many people knowing that you're buying this stock. Yeah, exactly. So if you see huge volume bars, but the price isn't moving much, that's because somebody or a hedge fund, or it could even be the company, is buying huge quantities of shares, but they don't want the price to move. There's multiple reasons that they could not want people to know that the price is moving, but usually it means that they're trying to gather as many shares as possible for a good reason. It's usually not a bad reason that they're accumulating shares.
Would you consider them greedy?
Not greedy.
Jerks?
Well, I mean, like JP Morgan, nobody, like, if you hear that JP Morgan's buying 30% in, I don't know, RGLS, the second that somebody hears that, the thing is going to explode.
Well, I'd rather PJ instead of JP buy it, because that's who I trust, the guy in the tux.
Exactly. Me too. I mean, you gotta trust every guy in the tux.
Right. I mean, if I could afford one, I'd buy one too.
So the reason that you want, when I was looking at Rumble, I mean, God have mercy. I knew it was going to run. I didn't know it was going to run as hard as it did, but usually accumulation is over a certain amount of time. It's not like tomorrow somebody's going to buy 40% of RGLS and keep the price at 85. But if you see, the best way to look at it is to look on the longer term charts, where if you're new, look for charts that are beaten down, and then look at the volume bars. You'll see huge volume bars, usually on the daily. That's what I would probably look at, not the weekly, because that's too hard. But if you look at the daily, you can see huge volume bars on things that are getting accumulated, usually by hedge funds. A perfect example is OTLK. For anyone swinging it with me, you'll see huge 15-cent spikes out of nowhere, and then all of a sudden the price is back down. and then you'll see huge 15-cent spikes every other day, and then the price is back down. That's a clear sign of accumulation. Someone is slapping it for like 100,000 shares, and they're not touching it. And well, actually, I think it was more like 300,000 the other day. But like Monday, they'll slap 300,000 shares at lunch when no one's really around, and then boom, the price is back down. Then on Wednesday, slap 300,000 shares, and then the price is back down. That is a clear sign of accumulation, because even though the intraday price is gapping up not gapping up, but hitting 15 cents higher, the ending price is not going to do much. So again, volume dictates price.
Yeah, that's really good explanation on accumulation, and I think it transitions to Amanda Cerny on Twitter's question. Hey, C, but wants to know accumulation versus distribution.
Yeah, so this is a good question, and I think that this has to do a lot with being able to read level 2 and price action. Accumulation, like I just talked about, is when the price doesn't move much,
but the volume's coming in.
And distribution is kind of the same way, but it's different. And when I mean different is that I mean, like, instead of someone market buying 300,000 shares, they're market selling 300,000 shares, and you'll see the price pretty much come back to where it was. And now distribution is a little bit different, and especially in this day and age, because traders are so touchy. Like the second that someone sees that, the second that someone does something like that, usually the momentum is just screwed. Even if there was no momentum, then they just created like an avalanche.
Yeah, I think a lot of the volume that comes in, even if it's just from like someone on Twitter's call, I mean, it makes the price action so unnatural where they want it to just continue as is.
Yeah, so I really think that when we're talking about distribution, it's kind of changed in the recent market because so many people get so skittish, and you have people flipping for 1 to 2 penny cents. And there's nothing wrong with that, but it's when you like load up like 20 grand and you flip it for 2 cents. That's usually, so distribution is a little different. But if we're talking about distribution and we're talking about how to exit a stock when there's news and how to know when it's kind of getting to its peak, again, that goes right back to volume. And so if you start to see huge walls, okay, and you start to see huge walls, and you're seeing that the walls are kind of being bounced off, that this price is going up towards the walls, and then you're seeing the price pull back a little bit, and you're seeing it go at it, and it just keeps rejecting, that's usually a sign to take some off, because that usually means, because again, you guys got to remember is that there's if something's up 100%, there's probably a short waiting for it, because there's money being made on both long and short. There's nothing wrong with shorts. They have to make their money too.
In my country, not so much.
Yeah, but in reality, there is money to be made on long and short, and the shorts are seeing the same exact chart that you're seeing. So if they're seeing that $1.90 keeps getting rejected, well, 190 is close to 2. So that's a mental resistance in of itself. And then on top of that, if they have walls there, that's when shorts are seeing an opportunity. So you really want to take some off. And distribution is just when you see huge walls, and they might be moving the walls down here and there. So like I said, accumulation is much easier to see, and distribution is much more difficult, and distribution has changed in the recent market. But distribution is basically, I consider distribution to be the same as price action. If you can read price action, you'll be okay.
Okay, we have one more thing to talk about in volume if you've gone through what you need to go to, and it's just a question about it.
Yep.
Okay, it's from Lulu Jorts, and he's saying, what is delusion? And that's not like the symptom of, the mental illness, but dilution, not delusional. I actually wrote delusion, which is kind of embarrassing, and how it plays into volume.
Yeah. So first off, huge shout out to Lulu. He and I collaborate on BMRA. Awesome dude. We talk all the time. But dilution is, if anybody drinks orange juice and they don't like it very thick, when you pour that water into the orange juice cup, you're diluting the orange juice.
You don't do that, do you?
Of course I do that.
Wait. What? You don't... I think, how much water do you pour? You do the 80-20 risk reward thing on that too?
No. But the same analogy applies to stocks. If I am Apple and I have 30 shares outstanding and I need cash, what I will do is that I will add an additional 20 shares at a certain price. Say the price is, there's 30 shares and say the price is at $1. If I add 20 shares at the market, naturally the shares outstanding are going to get bigger. Or if we think about it and we're talking about a pizza slice, if that analogy does make sense. If I have a pizza and there's 8 slices to a pizza and me and Dan were going to eat the entire, 8 slices by ourselves, 4 and 4. Actually, no, fuck it. 5 for me, 3 for Dan.
Naturally.
And Zach comes, then Zach is going to want.
Then Zach would just buy the pizza place.
No. Well, Zach's going to want his own piece of pizza, so that dilutes the amount of pieces that I have.
But you already ate your pizza, didn't you? Or you just still have the pizza?
No. This is when we're waiting for the pizza to come out.
Okay.
We're distributing the pizza.
So Zach gets here as we're cooking the pizza, and he's like, "I want pizza," and we're like, "Well, I have 3 and you have 5."
Yeah. So then I give him 1. That dilutes the amount of shares that the amount of pizza that I have. So how that plays into, so there's a few things that need to be when we're talking about dilution. If a stock does a common stock offering at the market, there's 2 things that you have to know. 1, the price. 2, the amount. Okay, and then 3, you kind of got to know why they're offering. Like Tops is just offering because it's a piece of junk. But KTOV was offering or BIOC was doing an offering so that they could, again, expand their COVID line. BIOC was doing it so they could expand the amount of testing kits that they were doing. So it's important to know those 3 things, because think about this. If the stock is at $1 and we have 100 shares outstanding and I do an offering for 100 shares at 10 cents, 1, that now doubles the amount of shares outstanding. And I'm basically saying that I think my stock is worth 10 cents. Now, it really depends on a few things, how they're going to distribute it. The thing that I like to see is that they don't do it all at once. Because when you do it all at once, that usually means that the new common shares are going to take up most of the volume. Whereas if they do it over a certain amount of time, then it's like they kind of like sprinkle it in. And sprinkling it in doesn't affect the price too much. So that's just something to be aware of. If they're going to do an offering, like UAVS did an offering, okay? What you want to know is, 1, you want to know how much. Like, does this really feel like a company that has a 10 million market cap, should they really be doing a $5 million offering? Chances are not. And if it's going to the CEO, I'm going to be pissed McGee about it. But if it's for ongoing orders and to expand something to add shareholder value, then I'm okay with it. And if they do it at a decent price and they're not like doubling the float, like if you see something that doubles anything above 20% of the float, be done with it. Be done with it. There's no point in it, because if they're increasing the float by more than 20%, then just be done with it. Zom, perfect example. Just be done with it, okay? Because they're being greedy. They know what the share price is going to do when they add a common stock offering of 20-25% of the float. They know exactly what they're going to do. That's terrible management.
Okay, so that sums up volume, and Hugh is a little pissed. He may need a break. Drink some water, buddy.
I am. Bad management, gets me going.
Dude, okay, so our last three segments are going to be Q&A. Hugh has some DD to give us, and then we got a scenario of a guy with 17K in his savings, and he wants to start trading.